Okay, let's go ahead and get started. Today is our Q3 stock market update. I'm Nick Johnson, and today we're going to be talking about a lot of exciting stuff. This has been a great market over the last year. It's been a fabulous first half of the year, and there's a lot on the agenda. For those of you who don't know me, I'm Nick Johnson, president here at Willis Johnson Associates. I've been working with clients for over 15 years, helping them optimize their tax situation, their benefits, and of course, guiding them through good markets and bad. Willis Johnson Associates is an award-winning wealth management firm. We focus on helping corporate executives and professionals optimize everything in their financial life. We're a fee-only fiduciary. That means we're committed to helping your best interest. So it's advice you can trust. We've doubled down on the fact that we're a planning-led firm. We have CPAs in-house. We offer tax preparation and filing for our clients. And of course, company benefit expertise. We're going to dive deep and understand your company's benefits so you don't leave anything on the table. Questions? Include them in the follow-up survey at the end of the webinar, and we'll get you a detailed answer. Okay, this has been an incredible first half of the year. So there have been 31 all-time highs in the S&P 500 this year. And frankly, if we go back to 2013, we've had a lot of all-time highs. So you can see each one of these bar charts, that's an all-time high. There have been a lot of all-time highs in the market over the last decade. The S&P has been fabulous. And for half of the year, 31 is really, truly remarkable. It's been a great year. If we look back the last 12 months, the best performer is large cap growth. Think of U.S. equities, think primarily tech, but growth companies, up 32%. Value is up 15. International is up 11. Small cap is up 9.5. And bonds are positive so far this year, up 2.5%. Over the last 36 months, it's a little bit more challenging. So believe it or not, growth and value are about tied over the last 36 months. Everyone's feeling like tech, mega cap, so exciting, doing so well. Well, in 2022, when everything fell, growth fell hard, and value stocks held up a little bit better. Traditionally, value stocks outperform over the full market cycle. And what we're actually seeing is value is a hair ahead of growth over the last 36 months. But what hasn't been working is everything else. So if we look at internationals, flat over a 3-year period, small cap is down 8%, and bonds, after having the worst 2022 we've ever seen for the bond market, is also down cumulative 8%. Now, with as much as the market's been running recently, and looking at valuations, generally we've heard from clients, should I hold cash? Should I not hold cash? Particularly when cash is paying out 4.5–5% CDs and high yield savings accounts. And I get it. This is a very unusual market. If we look at 2024, one of the things that we're going to see right here is that the pullback from the high on the S&P is very light. We've only had a 5% pullback so far in 2024. At any given point in time, over the last 5 years, the average is a pullback of 6.21. We can see the pain that we had here as the market pulled back in 22. We can see the COVID recession where the market fell 38%. But frankly, there has not been a lot of volatility recently. This has been an unusually good and unusually comfortable market. It's not normal, and it probably won't last. But this drives to the question, should we be investing? And I've got a number of clients that have said, well, I just got a bonus, but I don't want to put it in the market right now. I'd rather hold cash. Or, is it time to take profits? I think these are all really good questions. But believe it or not, when we run the numbers, you're better off investing at an all-time high in the market than any other day. If you invest at an all-time high, the following 5-year cumulative return from January 1, 1988 through December 31st of 2023 is 79.6%. Investing at an all-time high, you outperformed over the 5-year, 3-year, 2-year, 12-month, and 6-month time periods. And the reason is the market tends to go up and to the right? The economy grows, businesses grow, the market grows. There's a possibility at any given day that today is a low we never see again. So the idea being that today is a floor and the market only goes up from here, and you're never able to buy back in at today's price. And 30% of the time when we hit an all-time high, 30% of all-time highs have historically acted as market floors that we've never seen the market fall back down to that price again. We have no idea, is this going to be a floor or not? But frankly, if you've got that nice long-term 5-year plus time horizon and you can afford the risk, you shouldn't change your investment strategy just because we're at an all-time high. The other thing we're saying, okay, fine, don't change my strategy, but I'm getting 5%. CDs are attractive right now. Why do I take market risk? Why do I take bond risk when I'm getting 5%? Well, if we look historically, we've likely hit peak CD rates. The Fed has stopped raising rates. CDs have peaked. How do CDs do compared to other asset classes in the following 12 months? If we come back here and we look at 1984, CDs peaked at about 10%, but then bonds were up 30% the following 12 months. The S&P was up 31. Diversified portfolios up 30. Matter of fact, if we look at every single time period, the following 12 months after interest rates peaked, after CD rates peaked, equities outperformed and bonds outperformed, with the exception of 2000, when bonds outperformed but equities were down due to the tech bubble. Even today, we haven't seen a full 12 months since interest rates peaked in September of 23, but the S&P is up 29% and bonds are up 6%. Frankly, anywhere you could have invested outside of CDs over a long-term time period looks like in track for performance. So the next thing I want to talk about, this market kind of feels great. You know, it's a bit of a party right now. And there's an element of this market that is very comparable to 1999 or maybe 1997. So if we look at this chart right here, one of the things we're going to see before is there's been a lot of all-time highs recently. So actually, if we go till July 5th, we've had 34 all-time highs. When's the last time we've had a lot of all-time highs? Well, it was the late 90s. And what happened after that? The tech bubble. And we really had almost a 13, 14-year time period where we had a flat market, where it took us a while to get back to that threshold. We're seeing some similar trends today as we saw back then. If we look at the late 90s, we saw a period of low investor sentiment that rose over time. At the same time, the S&P 500 rose. Today, we're seeing some relatively low investor sentiment in late 2022. That's really risen quite a bit, along with the market. We're seeing AI, and specifically semiconductors, chips, being very attractive, very sexy from an investor standpoint. If we take the total return of semiconductors versus the total return of S&P 500, we're actually seeing a peak in semiconductor prices that we haven't seen since March of 2000. Well, we know what happened after that. If we look at just breaking down the U.S. equities, large cap equities to small cap equities, large cap equities are crushing small cap equities right now. Matter of fact, large cap is outperforming, think of the S&P 500, as outperforming small size companies by the most since 1999. Believe it or not, after the tech bubble popped from 2000 through the end of 2007, we saw massive small cap outperformance. Small cap equities were up 6.6% per year, and in a time period the S&P only earned 1.6% over an 8-year period. And this is kind of normal, right? I'm having a lot of conversations with people saying, why don't we just own the S&P? Why own small caps? Why own international? Why own? Because they're feeling right now that they're getting no return from small cap. But that's normal. There's a period of time, and a long period of time, where mega cap names outperform. There's a long period of time when small cap. And a long period of time where this, and a long period of time where that outperforms. And that's a normal transition. But when it corrects, it can correct fast. We're seeing a similar trend with market cap versus equal weight. If we think of market cap, the S&P's market cap. Equal weight is if we weighted every company in the S&P 500 equally. Right now we know Nvidia and Amazon and Netflix and Apple make up a significantly larger proportion of the S&P. Well, in the late 90s, what we saw is the S&P 500 performance was dramatically winning compared to equal weight. And again, we're seeing market cap, the S&P 500, dramatically winning versus equal weight. What happened after that? We saw massive equal weight outperformance. Equal weight S&P 500 earned 8% per year from 2000 through the end of 2007. Market cap was kind of ugly. Another trend, growth is outperforming value. Tech companies are crushing everything else. I've got a couple of clients that are saying, Nick, should I be in the NASDAQ? Nick, should we put more in tech? Nick, tech is the future. Look at what an impact it has. And I agree. But we got to separate out great businesses from great stocks. You can have a great business that's overpriced. When we're investing in the stock market, we got to be thinking about the price we're paying for the business. Today, growth is outperforming value at the highest we've seen since 1999. What happened after that? Value stocks were up 4.5% per year, whereas growth stocks were negative 3% per year through the end of 2007. So, what am I saying? Am I saying we're going to get a recession tomorrow? No, I'm not. I'm just saying certain areas of the market are looking very expensive and certain areas of the market are looking a lot more attractive. And our emotions are one of the absolute worst things with investing. And the last thing you want is FOMO, fear of missing out, chasing what's run recently. That's when you get burned, right? You want to take a nice, diversified approach and stick with it. And part of the reason I don't think we're necessarily going to have a recession is valuations aren't telling us we're there yet. If we look at the price to earning ratio on the S&P, we are 21 times right now. So the price we're paying for a dollar's worth of earnings, 21 times. If we look at March 2000, we really saw a massive bubble at 25 times earnings. So we know it can get a lot worse, right? Valuations can get higher, multiples can get higher. Matter of fact, we saw multiples were higher in late 21. They're close to about 22 times. The long-term average for the price to earnings multiple is 16.7. We're 21 today. We saw multiples close to 25 times. So the market's a little bit expensive. We have to be careful what in the market we're buying. And if we look towards the future, we're probably not going to see as great of returns on the S&P over the next 10 years as we saw over the last. But that doesn't mean we can't have a good market over the next 10 years. That doesn't mean we're going to get a recession tomorrow. I'm frankly pretty optimistic about this market. And partially what this market feels like, even though I was mentioning 1999 earlier, there's an element of this market that feels like 1997. And frankly, 1997 and 98 and 99 were good, and then eventually a reckoning came. So right here, this is the total returns on the S&P 500 for 1997. That's in green. And the year-to-date total returns are in gold. They look very similar. One of the other things that we're seeing is right around 1997, the top 10 holdings in the S&P were trading about 29 times earnings. That's very similar to where we're at today. So the top 10 holdings are expensive compared to average, but they're not the extreme levels, the 39, 40, 42 times that we saw right before the tech bubble burst. The other thing that makes today attractive is the top 10 holdings in the S&P have a lot more earnings than we saw in the late 90s. And that adds a lot more to what's going on there. So we are seeing earnings growth to justify prices. Part of what I believe has really been contributing to the Magnificent Seven, to large cap tech names, is they've seen earnings growth. Yes, 2022 is rough for them, and they had a 14% decline in earnings growth. But in 23, earnings growth was up 31%. We're estimating earnings growth for the Magnificent Seven to be up 30% in 24. But one of the things that we're starting to see as we get into the late half of 24 is we're starting to see a bit of recovery in the rest of the names outside of the Magnificent Seven, outside of these really big tech names. And that could be good for the longevity of the market. If it's just a few names carrying everything, if it's very narrow returns, that would be concerning. If it's broad-based market doing well, we're optimistic that there could be growth and this could last. One of the other things that we're looking at for valuations is outside of large cap, which is in orange, small and mid-sized companies still look very attractive. So large cap equities look expensive, whether you look at trailing price to earnings, forward price to earnings, price to book, price to sales, pretty much any metric. Small and mid cap look much more attractive from a valuation standpoint. And as the Fed begins cutting rates, likely with the first rate cut in September, we may see a rotation in which areas of the market do well. So one of the things that I've been sharing with some clients recently is Vanguard's 10-year market outlook. So Vanguard puts this together and updates this every once in a while, last updated May 15th. And they say, what are the average annual results going to be for different areas of the market? One of the things you can see here is that they're estimating U.S. equities to only earn 3.5 to 5.5% return per year for the next decade. They're most concerned about growth, right? Because the multiples are so high, trees don't grow to the sky, so multiples can't keep growing. We need to have earnings to justify it. They're much more excited about value stocks, small cap, but particularly internationals. One of the things I want to talk about is the consumer and earnings, because at the end of the day, earnings drive the market. Now, one of the great things about our country is that 2/3 of our GDP is consumption. It's people buying stuff. We don't need to export to other countries. We're less dependent upon that. It's not about government spending. We're less dependent upon that. It's people buying things. We're a capitalist country. And if we look at people today, people are in pretty great shape. They've accumulated assets. They've used COVID stimulus to pay down debt. Debt service ratio is unusually low, right? So debt service ratio, this is debt payments over disposable personal income. Disposable personal income, think about it like this. You get a paycheck. You pay what's your necessity to live, which in this case is usually a mortgage or a rent payment, and what do you have left over? What you have left over, what percentage of that, after mortgage, after rent payments, do you have to use towards debt payments? Credit cards, car payments, that sort of thing. Only 9.7% of disposable personal income is going to debt payments. If we look about 2008, when we had a true debt crisis, we had really too much leverage, we were in the 12.5%, 13%. So it's relatively low. Now, we are starting to see some early delinquencies in credit cards and autos. So we're watching it, but frankly, the consumer overall looks to be in pretty good shape. One of the other things that we've seen from the consumer is the consumer has saved a lot of money. People have saved a lot of money. I particularly love this chart up here. It shows the personal savings rate, and this was the trend line. People are saving about 1% of their income. Okay, this is the savings rate. But with all the COVID stimulus, people saved a lot more money. You can see the 3 different COVID checks that came out for different groups of people. And what that did is people ended up saving over $2.3 trillion. But then what happened? Inflation. And people still wanted to do stuff. And their incomes weren't quite growing as much. So to keep doing things, they're like, oh, I've got some money saved. I'll pull out, and I'll pull out. Well, the reason they're able to keep doing things, even though prices went up, is they decreased their savings. So there's still $600 billion in excess savings over and above the pre-pandemic trend. As that gets used up, things will get a little bit tighter for the consumer, but overall, people are frankly in pretty good shape. One of the questions I get from clients is, why is the Fed fighting so hard to bring down inflation? This is really painful for people. Credit card rates are going up. Cars are really challenging. It's hard to go buy a car today. There's a whole group of people that can't go out and purchase a home. Mortgages make home affordability just so challenging. Why is the Fed raising rates so much? Why is inflation such an issue? And I want to bring you all to the gold chart right here. This is real wage growth. So think about this as what's the income I'm earning minus inflation. So if it's positive, you can kind of see this area chart, that means wages are growing faster than inflation. If it's negative, wages are growing slower than inflation. We had a whole period of time for about 25 months when inflation was at its worst that incomes were growing slower than inflation. That makes everybody poor. And we have a country that's built upon consumption, that's built upon people spending money to go out and buy things. If people are less poor on inflation-adjusted dollars, that means we as a country are not doing very well. Well, the Fed had to fight this problem. And they fought this primarily by raising interest rates. And today, wage growth is positive, right? Real wage growth is positive. Incomes are growing faster than inflation. The challenge being, as they raise rates, that tends to be a speed bump to the economy. And we've seen things like unemployment go from a generationally low rate to ticking up a bit. We're still only barely over 4% unemployment today. The long-term average going back to 2000 is 5 3/4. But what we've seen is the Fed raising rates has been a bit of a speed bump. And we can see that in a lot of areas in terms of the job market. If we look at job openings, they've come down dramatically. Frankly, there's still a lot more job openings than we've seen. If we look at job quits, there used to be a ton of people leaving the workforce, quitting and just knowing, hey, I can find something else. That's going away. And layoffs have been ticking up. But frankly, if we look at any of these numbers compared to the long term, they look pretty darn good. One of the other things that we're starting to see is we're still hiring people. There's still payroll gains, but they're decelerating. I particularly like this. This is payroll, month-over-month payroll gains in blue, but this 3-month line right here. And you can see we're creating more jobs than we're removing, but it's at a declining level, right? So we're adding more jobs slower than we were, so the job market is getting a little bit tighter. Now, all of these things, interest rates going up, positive wages, the job situation getting a little bit tighter, is impacting the consumer. And we're seeing that in one area, particularly U.S. retail sales. So this is the stuff people buy as opposed to the services people buy. When I say stuff, think about refrigerators, think about cars, think about TVs, just computers. Anything people physically buy, that is retail sales. Well, what happened? During COVID, we're all stuck at home. People bought a ton of stuff. They fixed up their house, they fixed up their backyard, they updated their sound system. We didn't have a lot to do, so that's where we spent money. Post-COVID, retail sales has been mostly negative. Part of the reason is inflation's occurred, wages are growing, but now we're in a situation people have decided what's really important. And people are traveling more. People are going out to sporting events, to the theater. People are going on vacation, and they're choosing to spend more money on services than retail sales. Retail sales is slowing down right now. Here's what we care about, and here's what matters. If earnings are growing, if companies are growing, the market will do just fine. We can see here in gold how the S&P 500 earnings have grown over time compared to the S&P. One of the things that's happened more recently is the S&P has shot up a lot. But earnings really haven't grown for the last couple of years. They've been fairly flat. What makes us feel good that this is a market that could keep running, we're going to really be watching and need to see consistent earnings growth. Ideally, broad-based earnings growth, not just earnings growth from 7 names that are dominating the market. But if we look at consensus analyst estimates for 24, 25, and beyond, generally earnings look to be pretty positive. We're expecting 11% earnings growth this year, 14% next year, and 11% in 2026. Now, that's on the S&P. The Carson Group has put out their own analysis on small caps. And I mentioned small caps have been challenging recently. We're estimating 12.7% earnings growth in 2024, the Carson Group is. But small-sized companies are estimating 4%. But if you start looking longer, especially as the Fed starts lowering rates, we may see small cap really rebound quickly with higher earnings growth in 25 and higher in 26. So overall, you want to make sure we're taking a diversified approach. There is one area that's run a lot, large cap growth. We're not saying don't participate, but definitely thinking about rebalancing in this market. So let's talk about internationals. We've talked a lot about US. I'm going to start with a similar analogy that we were looking at. If we look at the late 90s, the S&P 500 looked brilliant. It was up 200%. Internationals were up 69. Emerging markets were flat. For this is a solid 5-year period. Today, the numbers look very similar. The S&P is up 86. Internationals are up 22. Emerging markets are only up 4 over a 5-year period. What happened after the tech bubble? Emerging markets ran. internationals did pretty good, and the S&P 500 was flat for over 8 years. So again, just because diversification isn't working short term doesn't mean you should drop it. Diversification is about decades, not days. Now let's look at what's been driving returns globally. If we look at the last 15 years over here, one of the things that we're going to see is that the total return on the S&P per year is 14.8%. Frankly, a lot of earnings growth. But one of the things that we've seen is there's been earnings growth globally, but yet the returns are nowhere near the 15% annualized return over the last 15 years. And the big question is why? Well, one of them is currency. The US dollar has strengthened compared to international currencies. So from the US perspective, that makes internationals a weaker investment. The other thing we've generally seen is we've seen weaker multiple growth. People are paying more in terms of price to earnings for a dollar's worth of earnings in the S&P. They're paying less for internationals. You can only get so much multiple growth. We've probably seen a lot of what we can expect to see on the S&P 500. There's a lot of room for multiple growth on internationals. And if things reverse and the US dollar weakens, which we go through cycles when the US dollar strengthens and the US dollar weakens, we could see a really strong run in internationals. Make sure they're a piece of your portfolio, particularly when you consider how cheap they are. The US is expensive. Right now, from a price to earnings relative standpoint, internationals are 2 standard deviations, a lot cheaper than US equities, and they're paying out much higher yields. So we do think they're attractive. Partially one of the things in our mind that is contributing to what's going on is we're reconstructing global trade. It used to be China was one of our major trading partners. And if we look at US imports, we buy stuff from the world. If we look at imports, we were buying over 20% of imported goods from China. It's now down to about 12. And we're seeing Europe, Mexico, Taiwan, Korea, Vietnam, and even India become a larger portion of our imports. But as we restructure the global trade environment based on what's going geopolitically, that takes a while to filter its way down into the stock markets and global stock markets. We may see India, Asia Pacific, and even Europe be outperformers in the near future. One of the other things I want to talk about, because there's been so much interest and so much in the headlines, is private equity, private real estate, and private fixed income. If we think about the market, generally a portfolio is comprised of equities and bonds. And we can see a couple different portfolios here, 40% equities, 60% equities, and 80% equities. And what we're showing here is we're showing risk and return historically. This goes back to 1990 through the end of 2023. And what we'll see here is that 40% equities are in the mid 7% returns and have some risk. The more equities we add, the higher returns we get, 8.5% returns, 60% equities. 80% equities is in the high 9% returns. But you add a lot more risk, a lot more volatility when you add more equities to the portfolios. The reason that alternatives are becoming generally attractive is that theoretically, if you add them to the portfolio, you can get higher returns for lower volatility. Here's a problem. Alternatives are not for, frankly, even most people. They're illiquid. In many ways, they have asymmetric outcomes, and you're locked up. You can't get your money out whenever you want. It needs a lot of due diligence, and there can be higher fees on the funds. But for certain individuals that have a very long-term time horizon and can afford the risk, alternatives can be an attractive addition to your portfolio. One of the things that we find interesting about alternatives is the yields. So if we compare that to public markets, you can see equities here in the green. Preferreds are currently yielding about 6.3%. Global REITs 4.5%. The S&P 1.3%. Public bonds in the blue, high yield bonds 8%, investment grade bonds 5.5%, 10-year treasury 4.5%. But there's a number of alternatives from direct lending, global transport, commercial REITs that are yielding very attractive returns. So yes, the money may be locked up. Yes, it may be a long time horizon, but the yields are very attractive for some of these asset classes. And this has been a growing area. If we look at the amount of money that's been going into private capital, whether private equity, venture capital, real estate, that sort of thing, it's been growing over time. 2021 was a peak, but still we're seeing a significant amount of growth into this area because frankly, the returns and risk historically have been quite attractive. Well, why? One of the things I've talked about previously is the small cap premium. Generally, over the full market cycle, small size companies outperform the S&P 500. They're not right now, but that's what we see over the full market cycle. One of the other things we've seen recently is there's been a big change. Less companies are deciding to go public and more companies are not listing their stock, right? And if we look at historically, there were 8,000 publicly listed companies in the US. Today, there's almost half that. At the same time, the size of the stock market has grown significantly. In the 1980s, we saw companies would go about 8 years before they would list and go public. In the 90s, they'd go about 9 years. I'm going to skip the tech bubble because that was unusual. But since the tech bubble, we've seen about 11 years. Companies are taking longer to go public. Part of the reason is it's hard to go public. There's a lot of regulation. There's quarterly earnings. You've got to react differently. And there's a lot of rules you have to follow. And there's private capital, private equity, private real estate. There's ways to get access to funds without going public that there just wasn't in the 80s. Here's a great example. This is SpaceX. And what we're looking at is the most recent fundraising rounds. And if you can see, this is the growth in the valuation of SpaceX in the billions. Based on the most recent fundraising round, SpaceX would be worth $210 billion. This would actually make it in and around the 35th largest company in the S&P 500, yet it's still a private company. So this is one of the areas that we are looking at for clients. For many people, it's not necessarily the right fit because there are lockups, there's not easy access, there's liquidity, and there is higher risk. But for the right individuals and the right time horizon, private equity, private real estate, and private credit can be very attractive. Okay, let's transition to what has been the big story and still is the big story, inflation and interest rates. I want to start with something really positive. There's a lot of people that feel like we're poorer today than we have been because inflation's gone up so much. But I want to refute that. This is a great chart put together by the Carson Group. It shows a couple of things. And green is disposable personal income. Going all the way back to February of 2020, we're seeing disposable personal income is positive, 26%. Employee compensation, what have wages grown, is up 25%. The PCE index, this is the Fed's preferred inflation metric, is up 18. Yes, there's periods of time inflation has been growing faster than wages. But if we look back to February of 2020 over a 5-year time horizon, over 5 years, income has been growing faster than inflation. So overall, we're in a pretty good spot. Inflation's been painful. We hit peak inflation of 9.1% in June of 2022. Inflation's come all the way down to about 3% in June of 23, and we've been stuck in the 3s since then. The most recent inflation reading is again 3% in June of 24. The challenge the Fed has is getting inflation back to its target of 2%. And if we look at what's driving inflation today, core goods, talked about retail sales, it's kind of the same thing as core goods, cars, televisions, laptops, etc. Prices are negative right now, year over year. If we look at what's driving inflation, shelter costs. Rent is still high, buying a home is still expensive. Auto insurance has gone up. But one of the areas that is contributing to inflation is dining, recreation, and other services. As I mentioned, people are spending money on vacations, on air travel, and on experiences. I think one of the things that we're getting post-COVID is we just are realizing life is short and we want to do stuff. And that is driving up the prices. So to get back to 2%, what does it take? Well, one, home prices are part of the issue. If we look at what's been happening with home prices, they've been growing a lot. They shot up post-COVID with all the COVID stimulus and interest rates at 0. They've slowed down the growth rate, but they're still up a lot. Housing affordability, how easy it is to purchase a home, is at a low we haven't seen since the early 90s. So this is a challenge and a painful challenge for a lot of people. One of the things that we all know is contributing is mortgage rates. you can see as mortgage rates have really grown, housing affordability has really dropped. Now, we are expecting the Fed to maybe start cutting rates in the second half of this year and possibly into next year, but I'm a big believer that the Fed is going to be cautious, so we're not going to get down to these 2 and 3% mortgage rates anytime soon. Would be highly surprised if that happened. One of the other things we have to watch that could be contributing is oil prices, right? If we look back over the last 5 years, we've averaged $73 a barrel. Today we're seeing $86 a barrel. And there was a spike up, and we know, when Russia invaded Ukraine. There was a lot of fear that's going on there. One of the things, if demand keeps increasing, but we don't increase our reserves and our supply, oil prices could keep going up, and that could really impact inflation. Because whether we're thinking about transportation costs, or whether we're thinking about shipping food, or whether we're thinking about global containers, or even bringing cars over from Mexico or China, energy costs going up makes everything more expensive. Now, what's the Fed been doing? As I mentioned this earlier, the Fed has been raising interest rates to fight inflation. Today, the federal funds rate is above the PCE, the Fed's preferred measure of inflation, by a significant amount. The Fed wants to get inflation back to 2%. They're likely going to cut rates later this year, but there's also a real possibility they cut them slower than the market expects. If we look at where the market is expecting, they're expecting one rate cut in August, down from 5.25% to 5%. And the Fed is expecting 2, maybe 3 rate cuts by the end of the year. I'm going to be honest, I personally think this could be a little bit optimistic. And part of the reason is the Fed has learned a lot from the 70s. I'm plotting the 70s here in blue, and the 70s are on the right in terms of the scale, and most recent inflation issue here on the left. So inflation didn't get bad in the first hump as we saw in the 70s, and the first hump of inflation in the 70s, it got into the teens, we got into 9%. But look how closely the green inflation rate is tracking the blue. What we learned from the 70s is that the Fed cut rates too quickly, started easing too fast, and inflation spiked back up and higher. It was more painful to kill, and Volcker took 2 ugly recessions to eventually deal with inflation. So, it's better off we nip inflation in the bud permanently. And that may mean that, yes, rates can start coming down, but it could also be at a much slower rate than we expect. I'd rather have a soft landing, a slow drop in inflation rate, than some ugly recessions. Now, of course, one of the things that we keep hearing from people is, how do we invest? Well, you've got to be thinking about equities long-term to fight inflation. Over the last 5 years, inflation has destroyed 18% the value of a dollar. 18%. Over that same time period, the market is up 102%. Equities over any long-term rolling time period, because they can raise their prices, which raises earnings, and higher earnings impacts the stock market. Stocks are the best inflation protection over the medium and long term. It's hard to predict the impact on the short term, but over the medium and long term, stocks are the best inflation protection. So if you want to protect yourself, you've got to be looking at equities. Now, I started with something positive. I want to end with something positive on inflation. Our country has had some fabulous growth. If we look back in the 1960s, we spent 17% of our disposable personal income on food. Most of that being food at home, because that's all we could afford. Today, people are spending just under 10% of their disposable personal income on food, and about equal amounts food away from home as at home. Incomes have grown, food as a portion of income has gotten cheaper, and we're better today than we ever have been. As painful as prices have been over the last couple of years, overall we're on a very good trend. Let's talk about bonds. Okay, we've covered a lot, but I'd be remiss if I didn't cover the fixed income market. Bonds aren't dead. We just had the worst year ever for the bond market in 2022. Bonds were down 13%. We've never seen anything like that. What I'm most excited about bonds is that the best predictor of bond returns in the future is not what's happened in the recent past, but is current yield. Current yield in bonds today, starting yield is 5%. So that means the average annual return for the next 5 years is 5%. And you can see here in every situation, so when starting yields were 11, you were getting right around 11. In every situation, other than the ugly inflation of the 70s, the starting yield is the best predictor of average annual returns. Today, we're seeing some very attractive yields for bonds that we haven't seen in a while. And unlike CDs and unlike cash, we can lock in these returns for a long period of time. Now, here's the downside. Current yields are not a great predictor for short-term results for bonds, right? If we look at one-year returns, current yields are not a great predictor. But if we're looking at current yields today, we're seeing 4.5% on the 10-year treasuries, 5% on the U.S. bond market. Investment-grade bonds are 5.5%. High-yield bonds are almost 8%. Municipal bonds, asset-based, leveraged loans, very attractive yields. Bonds should be a portion of your portfolio, particularly if you're coming up to retirement or in retirement and living off your money. Now, if you've got 10 and 20 years to retirement, or you're living entirely off pension and Social Security, fine, don't have bonds. If you can't sleep at night, have bonds. The Fed is expected to lower rates. They've pretty much come out and said they're feeling better about things. If the Fed lowers rates, interest rates come down. As interest rates come down, bonds make money. And frankly, if interest rates come down 1%, we would expect bonds to be quite positive because you collect the current yield and you collect the appreciation. Just because bonds were really painful over the last 3 and 5 years doesn't mean the next 3 and 5 years are going to be painful. Your growth stocks have run. Make sure you're rebalancing. But the most important reason to own bonds is if you're living off your portfolio and things get ugly, bonds are your protection. This is COVID. During COVID, the S&P fell 38% from February through the end of March. Bonds were positive. Treasuries made money. This was the great financial crisis. We had a 51% drop in the S&P 500, and it was a meltdown. It was a slow, ugly grind down. Bonds were positive. Treasuries were positive. This was the tech bubble. This is another slow, ugly grind down. Took us 2.5, almost 3 years for the S&P to fall 44%. Bonds were positive. If you're living off your portfolio, you need to have fixed income as a diversifier, not because it's going to necessarily make you money, but because when things get ugly, you can't wait 5, 6, 10 years to sell your equities, and you don't want to be forced to sell equities at bad prices if you're living off your portfolio. Outside of traditional bonds, if you've got a taxable account and you're in a high tax bracket, municipals are really attractive today. The tax equivalent yield on municipals are much better than treasuries. Whether we're looking at AAA, high quality municipals, or BBB, higher yield municipals, very attractive rates today on a tax equivalent yield. And municipals generally have lower default rates than corporates. I want to end the bond section with Vanguard's 10-year market outlook. We talked about it for equities, let's talk about it for bonds. As you may remember, they mentioned that they thought U.S. equities were going to have somewhere between a 3.5% and a 5.5% per year return over the next 10 years. Notice they're expecting bonds to have a 4.5% to 5.5% per year return over the next 10 years. With a little bit more upside for high yield bonds and emerging market bonds, and a lot less upside for Treasury inflation protected bonds. We're getting most of our returns. We're expecting, or Vanguard is expecting, to get most of the returns over the next 10 years from the fixed income side in a diversified portfolio. Make sure you're diversified. Okay, it's an election year. Depending on which side you lean, you may feel differently about this economy, and that's normal. Biden's the president today. Democrats feel better about the economy today than Republicans. When Trump's the president, Republicans feel better about the economy than Democrats. When Obama was in office, Democrats felt better than Republicans. This is normal. You want to be careful about your political views and how you feel about the economy influence your investment decisions. I talked about this earlier. Emotions are generally not good at making investment decisions. And we've seen good returns under Democrats. We've seen good returns under Republicans. So be really careful about adjusting your portfolio leading up to the election or after the election. Because frankly, if we get out of the market because our party that we don't love has control, we may be giving up a lot in terms of returns. One of the other things people have been asking me is, well, what about this? It's an election year. Election years are volatile. Shouldn't I just get out now after the great returns we've had and wait to get in until after the election is over? But believe it or not, the average return during an election year on the S&P is up 11.5%. That's unusually good. Election years are unusually good for the market. The year after an election year, the market's up 10.5%. That's also pretty darn good. So, frankly, you should be really careful. And I wouldn't be surprised if we get a little bit of volatility in September, October, leading up to the election. But you should be really careful about getting out. Because when the market recovers, the market moves, it does so fast. The market can respond fast. And if you're market timing, you can miss out on it. What's important is being patient, sticking with it, rebalancing in good times and bad. Okay, so where do we go from here? I've talked a lot about some areas of the market are really expensive and have done fabulous, and other areas seem cheaper and people are just wondering about them. The last time we were having this conversation with clients, and I remember starting off in the industry, we were having this conversation, everybody wanted to be in real estate, REITs. REITs were killing it and killing it and killing it. Coming out of 2008, interest rates were cheap, real estate prices got beaten up, people were making money left and right on real estate. And I was hearing from my clients, Nick, why do we own the S&P? Why don't we own more real estate? Isn't real estate going to have better return performance? It's doing so well. And now, today, real estate has been a lot more challenging. Okay? Today, we're having large cap growth killing it. And everybody's saying, my gosh, that's the only place I want to be. We've seen this before. We've seen it in the late 90s. And maybe it keeps running. Maybe it turns here. We have no idea. But the thing is, something can run for a while. A trend can happen for a while. And you never know when it's going to change. The thing about being diversified is sticking with things in good time and bad. Right now, it feels like the U.S. stock market can do no wrong. And we're in this wonderful period of where it's running. When I started off in the business, we were flat. We had no growth. The S&P was flat for a long period of time. We had the tech bubble, global financial crisis. I remember people telling me, why invest? The market's flat. It doesn't make any sense. And look at what we've seen recently. And here's the thing. It's normal for asset classes to have a run year and a flat year and a run year. And we've seen this over time. But the thing about being diversified is there are other things that could be working in your portfolio, protecting you from the drawdowns and making you money in the flat years. So you want to be careful of chasing what's been running recently. And if we look back over time, one of the biggest values advisors have for clients is taking the emotions out of it. Over this time period, the S&P was up 9.5%. Diversification, 60-40, 7.5. 40-60, 6.5. Inflation's 2.2. The average investor only earned 3.6%. And the reason is they tend to get in or they get out at a really bad time in the market. They say, hey, I'm missing out, I'm going to buy more NASDAQ. Hey, I'm missing out, I want more S&P. Well, we saw that story play out in the late 90s. I don't think we're necessarily going to get a recession today. There's a lot that makes me think that's not the case. But you have to be really careful about chasing what's run and selling what hasn't worked. Because then we're selling low and possibly buying high. Okay, so what does this really mean for you? At Willis Johnson Associates, we're a comprehensive wealth management firm. We work in your best interest. We understand your company benefits. We have CPAs on staff. We do financial planning with tax planning. We can handle your tax returns and bring it all together. If you're interested in meeting with us, we offer a complimentary first meeting. We'll do a company benefit and compensation assessment, review your tax plan and help you optimize it, and of course, go over your portfolio. Questions, include them in the survey at the end of the webinar. We'll get back to you. Thank you very much for spending the afternoon with me today.